Good morning, everyone. Welcome to Office Adda 24/7. My name is Niharika Valia Bhatnagar, and I am with you with the area of accounting and financial management. What are we going to talk about today? Everyone, I am done with the module A altogether. I am done with a lot of parts of module B altogether. Now we'll be proceeding towards the module C from tomorrow onwards, right? That means on Monday onwards, right? We have a series going on now. So on Monday onwards, we'll be starting with this particular session to be conducted like that. So let's begin with the session today. First is cash flow statement and ratio analysis. JIB November 2023, we are looking forward towards CFS as well as ratios, because today I'm going to take a part of CFS as well as ratios. Okay, here comes the first question. The first question says, accounting ratios helps in what? Interfirm comparison, intra-firm comparison, comparison with industry norms, or all of the above. What does it exactly do? Accounting ratios are basically relationships between two or more type of numeric items. It is basically nothing but numeric items. The numeric items which are going to have a particular relationship, there can be any kind of relationship. That is what they call it as accounting ratios. Relationships between two or more items of the balance sheet or the financial statements. What does it do? Does it help in inter-firm comparison? Yeah, you can compare two different firms of the same industry. Then intra-firm, within the firm, we are looking forward to what happened with the previous year, what is happening in the current year. Then we have the comparison with industry norms. See, the industry altogether itself is growing and we are going at a faster pace. That is a good thing. If altogether the industry is growing and we are not able to grab the opportunities, this is where we need to know where we are exactly standing in the industry, isn't it? This is an important area to look forward to, है ना? So in this case, it is all of the above. Done. Next point. DSCR. But this is one of the most important ratios that I've seen even in the bank promotion examinations as well. Not only in your examination, but also an examination which is related to your career there. So when we talk about DSCR, debt service coverage ratio, the full form is debt service coverage ratio. This is all ratios, everyone. There are many questions that I take from IIBF book as well, so that anybody who hasn't been following the IIBF book yet, or they are having any confusions regarding the questions and all, we are discussing it in the class itself. Other questions are also there. I'm covering up the IIBF material as well, so that you are able to cover everything, be it in the YT sessions, be it in the paid sessions. In the paid sessions, we definitely look forward towards more deeper analysis of these things. But in the YT sessions, we are covering those things, but from the point of view of MCQs. Debt service ratio talks about, see, the point is, there are certain compulsory payments. There are certain payments which are compulsory payments for the organization. If you have taken a loan, you cannot cry that you don't have money. You will have to make the payment. So debt service coverage ratio is used for which of the following? Judging the margin of safety before this fault in repaying the loan, judging whether the firm has borrowings disproportionate to the net worth, judging the capacity of the firm to service the interest on debt, or all of the above. What's the correct answer? Debt service coverage ratio talks about the financial health of the organization. Are they really able to pay back the certain amounts? Are they making any defaults in those amounts or not? That is another important point. So in this case, the correct answer would be, they're talking about their solvency. We're talking about the certainty in terms of their solvency. So in this case, the correct answer would be judging the margin of safety available before there is a default in repaying the loan. Okay? That's the correct answer. Which one of the following is true? Both EPS and PE ratio vary with stock market price of the company's share. While calculating debt equity ratio, fixed deposits from shareholders are taken as a part of debt. While calculating quick ratio, all current liabilities are not taken into account. Then debtor turnover ratio is the higher if the company sells more goods on credit basis than on cash basis. Okay, let's look at both EPS and PE ratio. EPS is earning per share, while PE ratio is price earning ratio. There where we have market price divided by earning per share. With the stock price of the vary with the stock price. Okay, when the stock price changes, then EPS is something which is related to the area of profit. It is not related to this area. So I think this part is definitely wrong. Earning per share is related to the net profit after payments of debenture holders, preference shares, whatever is left divided by number of equity shares. So in this case, we are not doing anything else. While calculating debt equity ratio, fixed deposits from shareholders are taken as a part of debt. While calculating debt equity ratio, fixed deposits from shareholders. Yeah, that's a form of debt as such. It is. Because whatever money we have taken from others, we are bound to pay it back. So this one is correct. Till now, this one's wrong. This one seems correct. While calculating quick ratio, all the current liabilities are not taken into account. Quick ratio is basically current assets upon current liabilities, where current from the total current assets we are removing stock or inventory and prepaid expenses. Both have been removed, and that is what we are left with. That is, we are left with quick assets divided by current liabilities. In this case, quick ratio has the is basically including all the current liabilities. So this one's wrong again. Debtor turnover ratio is higher. Debtor turnover ratio talks about in how much time the people are paying us. The debtors are paying us. It has nothing to do with the cash basis or something. Debtor turnover ratio talks about your net credit sales divided by your average debtors plus average BRs. In this case, where are they talking about cash basis? No talk about the cash basis, no talk about the total sales. They're just talking about in how much time people are paying us back. Isn't it? If this is about how much time people are paying us back, then it simply means we have nothing to do with their amounts. So this is the point D is definitely incorrect. So there is only one point which is correct, that is B. Okay? They are someone who to whom the organization is supposed to pay back. Which one of the following is true? Higher debt equity ratio increases the profit margin of the company. Debt equity ratio is an indicator of solvency. A high current ratio is always an indicator of efficient management, and depreciation is not an expense and should be excluded while calculating profitability ratios. Depreciation is an expense which helps in reducing the tax. How can we exclude it? वो तो पाप है. It's wrong to do that. It's a sin. Okay? It turns out to be a sin. Oh, I'm sorry. Since the answer is visible, high current ratio is always an indicator of efficient management. No. If I'm having too much cash, the very first thing that will be asked from me is, why isn't this cash invested somewhere else if this money was not required? If it was not required, it should not be with you. So this is also wrong. A high debt equity ratio increases the profit margin of the company. Yeah. Debt equity ratio, nahi. Debt eats away your interest. So interest is basically something that reduces your profit. So this is also not true. Debt equity ratio is a an indicator of solvency. In actual, it's basically an indicator of long-term solvency, not short-term. For short-term, we have current ratios. If I ask you money today, that do you have money today, and you say yes, that means you are having short-term liquidity. If I ask you that after 5 years, can you pay me back, and you're like, yes, I can pay you back, that is long-term solvency. है ना? And anything which is beyond 1 year is considered as long-term. That's the rule. Next point. Which one of the following statements is correct about fixed asset ratio? Fixed asset ratio is basically asset ratio of fixed assets and net worth. Fixed assets and long-term funds, a ratio of less than 1 indicates the short-term resources have been diverted for long-term, or none of the above statements are correct. Fixed asset ratio is basically knowing what is the amount of long-term funds that are invested and what is the amount of fixed assets that we have invested. See, to buy a fixed asset, I will have to have a long-term loan, not short-term. Okay, to build a house, how much money would I need? Maybe at this point of time to build a house, I need at least 50 lakhs. You know, if my plot is big and I need around 50 lakhs to build up that place. So shall I take a bank OD or CC for that? Will it be correct? Those are working capital based loans, not long term. They're not short term. These, see, the point is you have to make the payment over the period of time. The place will be built up and you will earn the money and then you will slowly pay it off. So this is totally a wrong concept altogether. So this is basically, if you have a long term fixed assets, for those long term assets we should have long term funds. This is overall long term funds. How much money is invested, be it shares or be it debentures or debt? I would say both equity and debt are involved in this. ठीक है ना? To build up the business, we'll have to look forward to all these things. Huh? That is what is included in this area. Next point, everyone. There is a current ratio of 3:4, current liabilities of 24,000. What is the value of current assets? Okay, let's look at this. It is 3 upon 4 is equal to CA upon CL. That's the formula of current liabilities and current assets. This is the formula for current ratio, and they've given the ratio already. So it's like 3 by 4 is equal to, current assets is something that I don't know about, while the current liabilities are of 24,000. So it turns out to be 3 multiplied by 24,000 divided by 4. And this comes out to be 18,000. These questions are super easy if you remember the formulas. If you don't know about the formulas, this is where you lose the important points. Okay, that's the basic rule, everyone. Done? Acha, tomorrow we are coming up with our sale as well. Sorry, tomorrow we are actually releasing our AFM book, right? Then whatever we are extra coming up with it, the complimentary points are still unknown to me, and I think even to you right now. So I think let's wait and watch till tomorrow, right? So we'll have to wait till 15th of September and till 8 p.m. So we'll be having our AFM book launch on that particular day. So please make sure that you are a part of this particular important event. And if you are looking forward to buying the physical book, then hurry up. That book would be available from tomorrow onwards. And if you're looking forward to it, then go ahead and buy it before the offer ends and the stock goes out. Okay. So this is the point. What's the correct answer in this case, everyone? The correct answer is 18,000. As I told you, in these questions, there is nothing. The calculation is almost negligible. But the point where we face problems is where the main area of facing problems is only and only one, that is in these kind of questions, when they are doing it, you tend to forget the formulas. There are so many formulas that people tend to make mistakes in the formula area. That is where they find it difficult. ठीक है ना? Okay, now let's move on to the next point. We are given current assets of rupees 5 lakh, current liabilities are given, as well as revenue from operations. That is, our sales is also given to us. And they are asking about the working capital turnover ratios. Working capital turnover ratio is basically RFO divided by working capital. Turnover ratio simply means you are connecting to the area of turnover. So in this case, when we are calculating the question, it goes like we have turnover or RFO here on the top or the numerator side. It is 28 lakhs. And what do you mean by working capital? Working capital is day-to-day working. The lights are on, the fan is working, AC is working, and then electricity is going on. Then we are also using water, है ना? Those basic things are required. Then I need someone to clean the particular area as well. There's a cleaner required, there's a helper required. So many things are required. This is basically something which I call the money which is required for day-to-day working. It is working capital. That is CA minus CL. It is 28 lakhs divided by current assets is what? 5 lakhs. And current liabilities is what? 1 lakh. This is your working capital. So this turns out to be 4 lakh. So that is 28 lakh divided by 4 lakh. So this turns out to be 7 times. Always remember all the turnover ratios. Turnover ratios talks about how many times that particular thing is in respect of the other. In this case, can we say WCTR means that what is the amount of operating capital or the working capital which is required in order to look forward towards our revenue? Out of revenue, which particular amount is always involved in working capital? Because a certain amount is always required, because we have to pay for the day-to-day things now. Without paying for the day-to-day things, things will not work out. We'll have to pay. Done? So in this case, the correct answer is 7 times. All the turnover ratios are expressed in times. Okay? Another question. The ratio of net sales to net working capital is liquidity ratio, profitability ratio, working capital turnover ratio, or none of the above. Ratio of net sales to working capital. Net sales is RFO to working capital. We have just done this same formula, everyone. Net sales is called RFO. Net sales simply means sales minus sales return. So the correct answer turns out to be working capital turnover ratios. Remember, all the turnover ratios either have sales as their main point, okay? Either they have sales or either they have COGS, cost of goods sold, as their numerator. And all of them are expressed in times. Hardly 3 ratios are there where the numerator is not sales or COGS. Otherwise, as expressed in their type only, they are connected with the turnover of the organization. Turnover means the sales of the organization. Okay? So these are called turnover or activity turnover ratios. Okay, another question. Cash and bank balance is 20,000. Account receivable, this is also current asset. And inventory is 2,80,000. These 3 are total current assets. The assets which are required within the 1 year. Then current liabilities, account payables 1 lakh. Bills payable 50,000. In this case, what is it that I'm getting? I am having 20,000 plus 2 lakh plus 2,80,000 rupees. A total of 5 lakh rupees is what? These are my current assets. A total of 1,50,000 rupees is my current liability according to the scenario, because we are supposed to pay to the liability to the people from whom we have taken money now. So within the period of 1 year, that is current liability. If the money is assumed, or basically it has to be materialized or received back within a period of less than 1 year, that is also a part of this. This is our current assets and this is our current liabilities. So the correct answer would be 5 lakh minus 1 lakh 50. This turns out to be rupees 3,50,000. The correct answer would be 3,50,000. Done. So this is it for the particular day, everyone. I hope this particular session was helpful. If it was, then please go ahead and check it out on our website or in our app. Our revision batches coming up, our regular batches are going on. If you're looking forward to our regular batches, so this is also a time, you still have time. Last 1 month is left, and if you are still thinking that whether I should go or not at this point of time, you should take the particular advantage of the time, and you should end the things as early as possible from your side in terms of your studies there. You have to go to the area of JIB and CIB. Go ahead and check out our JIB and CIB Mahapack. JIB CIB Mahapack is basically a cluster of both the things. You get JIB, you get CIB. है ना? In this case, it is available for 13,317 based upon your validity. You can take up the validity of 3 months or less. Then we have the period of 1 year. Then we have the period of 2 years. So the amount changes or varies with the validity of the particular thing that you're looking forward to. If you're looking forward to it, then you can purchase it for 13,314, which includes both JIB as well as CIB. Matlab you might be getting both. You will be getting both the courses, even electives of CIB, all the electives, right? You get revision batches, you get bilingual English medium, the batches which have ended, the batches which are going on, everything in the JIB CIB wing is opened up for you. Nothing is restricted to you. That is what we are doing in this area. So if you're looking forward to it, then kindly check it out on our website, on our app for further details. What you can do is, this will also include the area of test series as well. ठीक है, ebooks are there, 423 mock tests are there, 1517 video lectures are there, and even 1100 live classes are also there. So if you're looking forward to it, then kindly check it out. And along with this, if you're looking forward towards only JIB is available for 7728.08. So you can check it out. In this case, you will get 287 mock tests, 610 video courses, as well as ebooks plus 600 hours of live classes. So if you're looking forward to it, then kindly check it out